Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining our presentation today on the rise of the machines, Robo-Advisors Explained. Now, I'm very pleased to have Dr. Wes Gray, but rather than hearing me, I'm going to ask my colleague, Emmett Peppers, who works closely with Dr. Gray on a lot of other projects, to actually give us a brief introduction. So, Emmett, if you can, I see your phone's already unmuted, so let's get started.
Yes, thanks, Cynthia. It's my pleasure to introduce Dr. Wes Gray. After serving as captain in the Marine Corps, he received his PhD in finance and became professor of finance at Drexel University. He's a renowned author. He's written a couple of prestigious books in the financial arena, and he founded Alpha Architect, an SEC-registered RIA that's been successfully growing. So with no further ado, present Dr. Wes Gray.
Appreciate it, Emmett. Is it passed over to me now, Cynthia?
There you have it.
There we go. So let me get it set up here real quick. So first off, just want to say thanks to Interactive Brokers and for all those who are in attendance here. And the intent for the discussion today is really just to outline why robo-advisors we don't view as a threat per se to advisors, but really as an opportunity. And the intended audience is really meant to be focused on other investment professionals out there or advisors who use Interactive Broker services or others, and as well as investors who are just interested in learning more about kind of the backdrop and the business side of robo-advisory. So without further ado, we'll kind of scroll forward here. So to start off, what is a robo-advisor? And really, put simply, what we think a robo-advisor is simply leveraging 21st century technology to provide a better offering to clients. It's really nothing more than that. So what do I mean by that? Well, if you look down here on the left, all that means is doing things like asset allocation in an automated, sensible way, lowering costs to the consumer, enhancing transparency, keeping reporting simple, keeping the onboarding process simple, and just maintaining a very user-friendly, clean interface so clients have a better experience whenever they're, allocating to an advisor as opposed to getting, 200 pages of detailed documents that don't really tell you what you really care about. And I have two screenshots just from one of the systems that we're building in-house, but the idea is up here in the top left, you just have a real simple, transparent, this is your portfolio. And then on the bottom right, you have, again, a very simple one-pager. This is how much money you got, this is your return, this is what you own, and this is what it looks like over time. And you would think that'd be standard for a lot of, reporting portals, but it's just not. And the key thing we want to emphasize throughout is that robos are probably going to kill some advisors, but they're not going to kill good advisors. When we say good advisors, we mean those advisors that are genuinely trying to do good by the client and serving in the role as a psychology coach and an educational coach to make sure that their clients are actually doing the right thing and not jumping off the cliff if there's a large drawdown in the market or what have you. So again, robos are here to help us, not hurt us, and just make us better. So just some background on why did we decide in particular to go via the robo-advisory route. One of the things that we're trying to deliver to the marketplace is what we call affordable active management. But the question is, how do you service folks that call us up and say, hey, I've got a $50,000 account, can you guys do a managed account for me? We are, 9-person shop, all technology kind of engineer types, and that's just not going to be a very good business model for us in the future. So we said, hey, this robo may allow us to address this problem because a robo is going to give us scalability, and by leveraging technology, we can also deliver what we consider, reasonable services at affordable cost. And for others, it's also nice because, one, it helps you minimize your distribution costs because it's delivered via the internet, which is, in many respects cheaper than hiring 50 people to go, pound pavement. It's scalable because everything is technology driven, so the marginal cost of servicing an extra client after you've gotten the software built is pretty low. We happen to have technology people, so it made sense for us to do it. And then we've decided to partner with IB just because we thought their back office trade execution pipes were the cheapest. They didn't do a lot of the payment for order flow schemes that a lot of the other brokers do. And the bottom line, though, is that automation technology allows us to make things affordable, which helps us fulfill our particular mission. Now, the objectives for today's discussion, and feel free to raise questions as we go here. I'll try to answer them in the panel. Is one, just kind of outline the rise of robo-advisors and why they're here and probably going to be here in the future. Discuss why these things matter. Talk about ways in which we can view a robo-advisor as a tool to help us provide better services, not as a replacement for us as a human being, and then just talk about some of the various options that are out there that advisors can pursue and or investors. Okay, so what we have here is basically what we call the evolution of financial services, and really big picture what's going on over time. Costs are going down, transparency is going up, and there's becoming more and more what we call better buyer control. Basically, the buyer of financial services can now control what pieces they want to buy and from whom they want to buy it. So historically, as represented by the monkey here, unfortunately, in the early days, it was all about stockbrokers. So a broker would give you advice, and they got paid on commission, and then they would oftentimes put you in expensive products that also had really high fees. So it's kind of a double whammy of conflicted interest as well as really high cost. Time goes on, people are like, well, we don't like to pay all these high costs. Can you get it down somehow? So, costs started to come down, but because a lot of the advisory services were distributed via banks and large intermediaries, it's still a lot of times conflicted advice, and frankly, it's still kind of expensive. And then we move forward to today, where a lot of great things have happened. Primarily, this move towards independent fiduciary-only advisors who, in theory, have less conflicts of interest. And there's also been a plethora of new products in the marketplace, primarily driven by the ETF marketplace, where now you can access exposures at much lower cost. And that's awesome. So that's kind of where we sit today. But where do we think the future might be going? And again, this is who knows, but we think it's going to just get even lower cost. And we think this 1% fee for the advisor, the human advisor, the human's always going to be involved, but we think that fee has got to come down. And the way it'll come down is because advisors are going to embrace these robo-technologies, which allow them to basically pass through lower cost. So we think the future is going to be a future with lower costs, much more focus on empowering the individual investor because they got ETFs out there they can buy, they can go to their CPA, their lawyer, and if they choose to pick an advisor, they can do so, and that advisor will be able to offer them their services at what we think is going to be an even cheaper cost in the future. So to recap, we think the trends are lower cost, more transparency, and basically better buyer control in the future. And we think robo solutions can help make everyone in the financial advisory business better. So why do we think this might be the case? Well, if you look back historically, typically how financial services are being delivered is what we call the old model. This is the banking or the trust model where all your services are in one place. You pay one flat basis point fee of whatever it is, 100 bips or 150 bips. The sales and distribution for these services are all intermediated, where you get a king's ransom if you bring in the widow and what have you. The new model, we think, is a model where there's now multiple service providers that are very focused on delivering one particular service very well and very efficiently, And a lot of these sales are done direct consumer because it's typically someone with a website who's came up with a, great cloud-based platform for financial planning, or in stock picking. A lot of that's being done with ETFs now. And where Robos sit is in this asset allocation piece, where traditionally kind of the mother lode of value, at least pitched by, Acme Trust Company or bank company over here, is you paid them the big fees because they added a ton of value on this asset allocation because they had all their economists and all their high IQ folks that would do this. Well, now this is being delivered very efficiently, very transparently, and very cheaply via the Robos. And the bottom line is technology is disintermediating finance, whether we like it or not, and it's also dismantling this one-stop shop concept. So it's just something to think about and understand as we move forward in the business. Now, this is really the bottom line slide, and the one that is, I would say, most scary, but also provides the most opportunity for both investors and advisors out there. And the problem is, whether we like it or not, asset allocation now has a clear, transparent price of essentially 25 basis points. So if we're an advisor charging 1%, let's say, and we know the market price in general for asset allocation, again, whether we like it or not, or whether we agree with the other person's way they go about it, it doesn't matter. The price is 25 bips, which means we need to figure out and convince our clients or our consumers, how are we creating 75 basis points of value? And if your argument is like, well, I'm, a great asset allocator, they're like, well, yeah, okay, you're good at that, but that's only worth 25 bips. So what is the 75 bips for? So that's why Robo-Advisor is really interesting, because now they make us focus as an advisor on making sure that our value proposition is very clear. And again, 25 bips is what asset allocation is worth, whether we like it or not. So we need to make sure we can justify our fees if we're going to have higher fees. And why might that be plausible, though? Well, if we think about it, we as human beings and human advisors, we can offer some value-add services, none of which can be done, or none of which we should be doing on the top here. These are all services and operational issues that computers and algorithms just do way better and way cheaper. So we should hire, as an advisor, the computer to do so. So streamline back office, digitize compliance, better, more, or smarter lead generation by maybe having blogs or better inbound content marketing programs. The bottom line is we can lower our overhead expenses, streamline a lot of this back office, which traditionally has cost a ton of resources, and pass through that expense in the form of lower prices to the consumer. And we also get a focus dividend, because now we're not worried about filling out all this paperwork for compliance or running our asset allocation systems or what have you, because now the computers have simplified that. We can focus on things that actually justify that 75 BIP marginal cost over the asset allocation piece. And those are things like investor education. And what do we mean by that? Well, we think this is the biggest value add that an advisor can add to a client that a computer, frankly, can't do yet. I mean, who knows in the future, but if there's a massive 50% drawdown in the stock market, that investor, that psychology coach, that investor educator guy, that advisor needs to be telling that client, hey, don't go all to cash, maintain the program, follow the model, do what we talked about beforehand. And that there in itself is worth, its weight in gold if one actually provides that service. And you're going to be allowed to focus on that if we leverage and embrace robo-technologies. Same thing on estate planning and family communication. If you deal with high net worth, ultra high net worth, this is, everyone's got a different situation, and it just requires a human to kind of sort through all that. So we can focus more there. Another thing that maybe will go the way of the robo at some point, but I don't think is there yet, is an advisor can add a lot of value in the sense that if you have 10 accounts, 3 trust accounts, 6 or 7 different qualified accounts and maybe 1 taxable account, it would be nice if we could implement a plan to emphasize total tax management across all these accounts as opposed to just, within one account we optimize on one solution. And that's something that technology is getting there, but a good advisor can still add a lot of value. And then finally, and this is not for everyone, but I know this is part of a lot of advisors' pitch, there's a lot of, private vehicles like hedge funds, private equity, and venture capital, where, frankly, a computer is just not going to be able to do the due diligence on those strategies as well as the human being can. So, and if we believe in those exposures, and I'm not saying that we should, but if we do, we can now spend more time actually doing something that adds value in theory as opposed to toying around with asset allocation models that, frankly, the algorithms are probably going to be just as good as the human is. Bottom line, robo-advisors will allow us to have more time to focus on areas where we can actually still add value as a human being. So what are some different ways we can actually put this into practice and get the ball rolling? Well, the first one here is just, again, leveraging robo-advisors back-end technology to make our offering better. And the problem with that is it's going to require CapEx and a little bit of getting away from the status quo bias, but in the end, it's an investment in our future to provide a better client offering. The second thing robos are going to allow us to do is traditionally advisors have to focus on obviously big accounts because every account requires a lot of work. Which means if you have someone with, say, 50 grand or 100 grand and you really like them, but economically you can't service them, a robo-advisor will allow us to now service that client, and maybe we don't make a ton of money, but at least you're not losing a ton of money working that client. And then clearly over time, as people invest and earn money, hopefully that account will grow and it can grow into a relationship that's more of a win-win for the advisor and for the client. And then finally, the last two, which we think are really important, is streamline the onboarding process, making it simple and easy for folks, and also making the reporting very transparent so they know exactly what they own, exactly how much money they got, and exactly what the returns are. Whether those returns are good or bad, we think that's important, and we think this onboarding process is extremely important as well, because the last thing that we want to deal with, which currently we always have to deal with, is paperwork, and the clients are mad they got to fill out this IMA. It's just a total nightmare. And if someone could figure that out, it would be better for the advisor and it would be better for the client. Now, what are some solutions out there that basically offer to do this for advisors? And I'm just going to laundry list a few that we've personally looked at and examined, but Betterment. So a lot of people know Betterment as a front end for doing basically firing a human advisor, but what a lot of people don't know is Betterment Institutional actually helps facilitate advisors. And you can go on their platform, leverage their technology to do all these things we laundry list here on the left, and I don't remember the cost. I think it's like 15 or 25 bips, but for 15 or 25 bips, you're the 21st century, and now you can just focus on adding value and finding new prospects and what have you. Some other solutions are GemStep. They're a technology provider that, again, just facilitates all this back office stuff to move you into the 21st century. Modespark is a newer entrant. They're actually pretty cheap. I think it's like a flat fee of $300 or $400 a month or what have you. And again, that's Modespark. We know that Robinhood is actively exploring the concepts. Where Robinhood, if you're unfamiliar, is the zero commission broker, and they're actively looking to partner with various RIAs to maybe use their front-end technology and back-end technology to make an RIA's practice look better. And then finally, we're trying to do this, build a technology solution on top of interactive brokers in particular, where stage one is to get it working for our own practice, but stage 2, and for the right partners, offer this out to other advisors who like the idea of robo and like the idea of automation, but they want to work with IB as the back-end broker. So move forward here to the final conclusion. Bottom line is, we don't view robos as a threat, but as an opportunity for advisors to essentially differentiate and become more efficient. And we think robos are on trend with a lot of themes such as lower costs, more transparency, and essentially a better client experience. And in the end, we think it'll be a win-win for everyone, at least for those who embrace the technology. And with that, I'll leave it open for questions and other concepts out there. So we got a question here from someone that says, is a concept like co-vestor a type of rival to robo-advisors? And I'd say yes. So there's a lot of different solutions out there that are going to be competitive against robo-advisors. One would be a concept like co-vestor. Another one, I think it's called motif investing, where you can enter in a theme about, I like cybersecurity stocks, and it'll just come up with individual stocks and allow you to buy those on the fly. That could be a competitor. And another one is ETFs themselves. For example, there's an ETF Ned Faber has, I think the ticker's GAA, where it's essentially an ETF of a whole bunch of ETFs where the asset allocation is already embedded in that system, and it's just one ticker you buy. So clearly that's also a competitor to robo-advisors. It's just another technology that's on theme with lower cost, better transparency, and better client experience. So again, robo is just one solution to solve that we think is probably a good one, but it's not the only one. Okay, we got another question here. It says, I hear easier onboarding used as a rationale often for robos, and I can see that for new clients, but that's a small percentage of AUM when compared to current clients. So, okay, tracking. So if I can summarize this question, the pitch behind a robo-advisor is like, well, you can get better onboarding, and that's great. But if I'm already an advisor who's got a large practice and it's less now about onboarding, but more about servicing my current client base, where's the value add there? And this goes back to this slide. And I don't laundry list all of them, but I think the value add is you basically just become more technology focused and efficient in all your operations. And a lot of, maybe you already have this, but by leveraging robos, which again is for in our mind, robo is in one sense an asset allocation structure, but really it's just a way to digitize and enhance like the customer experience, and instead of doing paperwork and faxing on all your compliance quarterly sign off on ethics, maybe you should do this in the digital format through digital signature on some portal that's integrated into like a robo-advisor solution. So I agree. It's not just about onboarding, and maybe a lot of robo-advisors overemphasize that as like a key benefit, but I think it's just the broader idea that a robo solution can offer us a way to essentially technologify, if that's a word I just made up, everything in our practice, and hopefully free up bandwidth to focus on value add. Okay, someone asked a question. Do you see robos enhancing the risk profiling for clients away from the norm of low, medium, high to something more meaningful and accurate? So that's an excellent question, and as we all know, is either being an investor or being an advisor, is you can ask people till you're blue in the face, okay, the market goes down 15%, what are you going to do? Are you going to sell all your assets, or are you going to buy more? And when they're sitting there on their computer or they're sitting there face-to-face, yeah, they may say one thing, but then in practice, they're going to do something completely opposite. I talked to actually a psychologist about this, and I think there is a way for technology via gamification or via enhancements in essentially learning to really get better and smarter about ascertaining an investor or a client's actual risk profile. And what do I mean by that? Well, just, again, going back to the Marine Corps, one of the things about training is in order for training to be effective and for learning to actually occur, you need to get effective, immediate feedback. So if you're on the rifle range, you shoot down range, and if you're off target, they're immediately going to give you like a wind adjustment. You click it, and now you shoot again, you're on target, good to go, I learned, I know I need to make like 2 clicks wind adjustment. The problem with financial markets is the wind adjustment here only occurs once every 10 years when the market blows up, because that's when you actually get to see and feel your real risk profile. So we think via technology where if we could somehow simulate, again, in as realistic scenario as possible, where someone can maybe play in a game of some sort where, hey, the market's down 20, here's your investment profile, you see it in real time, and they're sitting there answering questions. We think there's a way you could probably get better at that besides, you want low, medium, or high, and having a better, cleaner onboarding process to really understand an individual's risk profile. So we're not doing that explicitly. That's something that on the horizon I think is a huge opportunity, and obviously, I think someone needs to figure that out. Okay, let's see here. Another question. Okay, so given the fact that unlike other investment solutions, this is supposedly made to order for an individual client, how does one compare between the various robo offerings right there in the market? So again, I think that's an outstanding question, and it's really difficult because it's an emerging industry right now to really understand who are all these robos, what the heck do they actually do, what are the actual costs of these things, and frankly, that's another business opportunity. And I'm sure someone's working on this, but if someone could create the kind of, consumer reports of robo-advisors, that would be a really good value-add service. Because another problem is a lot of robo-advisors aren't transparent about the performance of their portfolio. Like if you go to Wealthfront, for example, you can't figure out what their GIPS-compliant track record is. And if someone created a portal where they said, hey, here's the 20 robo-advisors, here's their performance, here's their costs, here's what they do, et cetera, I think that would be an amazing service for robo-advisor business right now. So that's a great question. That's an entrepreneurial opportunity. I encourage someone to explore that because you probably could make a great business out of it. Okay, another question here says, how do you view zero BIP service fee robos such as Schwab Intelligent Portfolios and Wise Banyan shaping the cost of robos over time? Is Schwab the clear winner? So excellent question. And this is a situation where there's now we're talking about the business sustainability of a robo-advisor, and we're of the opinion that it's dangerous to be someone like Wealthfront, potentially, because all you're really doing is charging a fee on top of a commoditized product run by a firm called Vanguard, who obviously everyone knows about. And Vanguard's definitely the low-cost producer, and they have human advisory services for 30 basis points, and they control the underlying products. So naturally, assuming Vanguard could ever get their act together on the technology front, which is a massive assumption, but assuming they could, they should be the winner in that marketplace for buy and hold passive portfolios, hold over the long haul, and displace Wealthfront. I don't know if that'll ever happen because, again, it relies on an assumption that Vanguard will somehow embrace technology and be able to outdo what Wealthfront's doing in this particular case. But the end state is that the underlying product manufacturer should be the one running the advisor, and they can deliver it at much lower cost, essentially as a loss leader, because they can make money in other venues. And in the case of Schwab Intelligent Portfolios, what's their business model? Well, they'll give away the asset products for free. They'll give away the robo-advisor for free because they just want people on the platform trading because they can get fees on payment for order flow schemes, commissions, charging, margin spreads between their cost to borrow and what they, lend out margin to people. So for them, it's a loss leader. Give it away for free because they make money other ways. And we think long term, you're going to see that more and more. I know iShares also has kind of a robo platform they offer now to allow people to pick and choose amongst the iShares funds. There's an element of that in our robo-advisor as well, because we're an underlying product manufacturing firm as well. And that makes sense. The vertical integration allows one to basically do things at a cheaper cost, because you don't need to make margin on every element of the vertical chain. You don't need to make, on the asset allocation, you don't need to make money because you can make money on underlying products. So in the end, that would be the real end state of the business. I don't know if it'll go there, but certainly hitting that way. So question here, how would one know which advisor to invest in? Don't they need long track records? How do investors, allocators know? Okay, so this goes back to the question of, how do we know about robo-advisors? How do we assess what they're doing, if they're doing well, who's doing what, who sucks, who's great? Again, this is an entrepreneur opportunity where if somebody could create the consumer reports of robo-advisor, I think it'd be an amazing service. Here's what these people do. Here's their all-in true effective cost after sorting through all the non-transparent things. And here's their track record, and here's their capital base, so they're not going to go bankrupt next year, and what have you. And I think that goes back to the original question. That's a service that's needed out there. So another question here, a really good one. How do you balance the transition to Robo for new clients versus legacy clients? Different fee structures and even management of accounts. So again, I think this is important for legacy advisors, not legacy advisors, but advisors that have been around for a while that kind of are in an old methodology that would like to transfer to a more clean, efficient, low-cost structure, but there's clearly a lot of transition costs. And in many respects, the transition cost may be so high that kind of the legacy business just stays on the old pipes, and then the new clients and the new business starts running on the new pipes, just because transitioning old clients over to a new model is it's too risky. And that's something that's an internal business strategy where, obviously you have to be careful, because if you're charging higher fees and doing things that aren't as 21st century to one set of clients and then doing something different for another set of clients, there's potential conflicts of interest. And, obviously, like SEC is always concerned about these things. So that's a challenge. And obviously, in a vacuum, you just go from one to the cheaper, more efficient version. I understand the world doesn't operate in a vacuum at all. So I think that'd be an internal situation you have to figure out and to deal with the conflicts of interest especially. Is Alpha Architect listed raising funds? No, we're not listed, and we're currently not raising funds. With respect to, I assume this is a question about like venture capital investments or whatever. With respect to that, no. We're already well capitalized and kind of cash flow out to do it all in-house. Do you think the current offering in the U.S. have already plateaued? And then the question here is, is this going to ever come to, the UK or Canada or other markets where there's a lot more vested interest and kind of the banks control the flow? I would say in the U.S., there's a lot of great things coming out there, but it's still very much an emerging market in the sense that who knows how they end up. All I know is it'll probably be good for consumers. But clearly the real opportunity where the highest margin opportunity to really, cut costs and create efficiencies is in markets, in international markets where there's a lot more regulation, a lot more vested interest. I'm thinking about Canada just offhand because I've been talking to some folks up there. And it's really hard. Everyone knows the structure up there is terrible and everything's expensive, but and I know people are trying to solve how do you make this more efficient and better for clients, but I'm just not a lawyer and I'm not up there, but I assume that whoever could figure out how to do robo or something equivalent up there would really be disruptive. I just don't know much about it, to be honest. Yeah, so someone has a great question here. They say, hey, you refer to technology as a critical success factor in separation from the classic model, and then just talking a little bit more about, how that would differentiate you. Honestly, I think it's, again, it goes back to what we believe is the trends in the industry, where those trends are essentially lower cost, more transparency, and a better client experience. And the only way that you're going to be able to do that and still be able to, feed your family as a traditional advisor is if you're going to have to deliver lower cost eventually, you're either going to have to take a profit margin cut or invest in technologies and software or different, workflows or systems that allow you to run your business more efficiently. Because then even if you have to lower your overall cost, your take-home is roughly equivalent. So, that's a great question. I just think that in the end, in 5-10 years from now, charging 1% advisory fees to just be the asset allocation guy on top of a bunch of ETFs that anyone can trade in their account is just going to be more and more a tough value proposition to propose to the marketplace out there. And if you can do it, God bless you, but I think competition is going to make that more and more difficult. So anywhere you can use technology to basically make your operation more efficient, more cost effective, it's just going to protect you and your livelihood in the future is what I would say. How you do that is obviously a challenge, though. And this is just a short talk about just exploring ideas. Okay, so really great question. Someone asked, hey, robo-advisors going forward, the products that are currently available, they aren't dynamic enough. So a lot of them are just net long and, essentially buy and hold annual rebalance and, call it a day. So I think this in particular is a great opportunity for a lot of startup, asset management focused firms that have had challenge traditionally with distribution, because this is exactly on point. Right now, the big players in the marketplace are essentially, hey, we're a robo-advisor, pay us to, essentially hold Vanguard funds, buy and hold. And that's fine. It's transparent, clean, and you don't have to think about it. But really one of the big opportunities, and this opportunity that we're kind of going after, is what about doing like more tactical asset allocation models, adding trend following in there, more like traditional what are considered like global macro concepts in a hedge fund world. What about bringing that to the forefront? And maybe it's not going to be 25 bips, but maybe it's not 2 and 20. So I think smart entrepreneurs and kind of robo-advisors stage 2 are going to be much more in line with that view as opposed to just let's just go buy and hold Vanguard funds and call it a day. That'll always be a business model as well, but I think the opportunity for more dynamic robos is definitely there. Okay, so if the market price of financial advice is 0 to 25 bips, and most pension plans and other default options charge 1% or more, who will expose the fraud happening every day? Great question. And again, the financial advice, let's just be clear, really it's the asset allocation advice seems to have a market price of around 25 basis points. Clearly, financial advice, you could argue, is a much more all-encompassing offering that goes beyond just the asset allocation piece, especially if you're dealing with larger, wealthier clients or people that are invested in alternatives and what have you. But the general takeaway is, okay, financial advice should be a lot cheaper than it probably is, and it's unclear what a lot of advisors' true value proposition is. And the question is, when will this be exposed? I think you're seeing it in real time. And, we just wrote a book, frankly, called DIY Financial Advisor, which is essentially the intellectual argument for why someone who has the discipline, is willing to invest a little bit in time and education, doesn't even really need an advisor. Now, in the same breath that I mentioned that, and we literally wrote a book about this, we also understand very close to the vest and close to the heart here is that knowing the psychology of a lot of people out there, they frankly don't have the discipline to stick to a system and do the right thing, and they actually need an advisor. So for a certain set of consumers, you know, the scam or the fraud, as you mentioned here, is being exposed, but we also understand for a certain set of consumers, this investor education or kind of psychology coach benefit, because frankly they just can't follow a system, and they're going to be the people that jump off the cliff when the market blows up. It still is probably arguably worth them paying, you know, 50, 75 bips, or heck, even 1% for a good advisor that actually keeps them disciplined. So it's not a first best solution, but it's a first best solution given you're not able to have the discipline to do it yourself. Is Alpha Architect offering products internationally? So I don't want to talk about our own products here on that. You know, feel free to reach out. Just try to keep this focused on the robo space here. Another question. Someone just mentioned, hey, in robos, you know, what about trend following, volatility strategies, as opposed to just buy and hold? 100%. Those should be coming out to the market. Those should be offered up to, you know, investors out there who maybe think that buy and hold is interesting, but if they can access, you know, more sophisticated models that are more dynamic and it can be delivered in a way that's not, you know, crazy expensive, you know, I think that's also going to be a compelling area of growth for robo-advisors in the future. So, wow, so that was a lot of questions. I don't know if anyone has any other questions. We'll hit them up. Otherwise, I think we'll probably conclude the session here, and happy to address, you know, questions offline if you think about it in your time as you sit here and digest a lot of the material we discussed here.
Well, Wes, I'm going to jump right in for just a moment here because I do have one piece of business that I'd like to get everyone to respond to. And notice I've just opened up a polling panel on your screen. There are 3 short questions there and 2 are multiple choice. So I do ask you to make these selections and then use the submit button in the lower right-hand corner of the screen. Now, IB's management requires I run this in each event, so your feedback is extremely helpful. And by the way, I'd also like to put a plug in because we are working with Wes on another event coming up in December. We're taking a look at picking the right robo for your portfolio. So that's in the works. We've got it penciled in early December. Don't have it listed yet, but it will be available as soon as we do get it in and approved. So make sure you do check the Interactive Broker website. Under the Education menu, you'll find a webinars link there where you can register for any of our upcoming recordings. Well, I'm not seeing, by the way, everyone, thank you all. The poll did end, and I appreciate your responses there. They really are very helpful. Now, since I'm not seeing any additional questions come in, I do want to thank Wes Gray for the work you put into today's presentation. Excellent information and a very lively Q&A session as well, Wes, so thank you very much. I do want you to know that today's presentation has been recorded and will also be sending you out a direct link to today's recorded playback in case you want to come back and review the concepts that Wes went through today. By the way, there's also webinar notes or a copy of these slides that will appear as you exit today's session. So if you're looking for the information or the contacts that are included on those slides, make sure you access and you can even download and print from that separate browser window. And thank you. Wes put his email address directly in the chat panel so everyone can copy it there, but also it should be included on the slides here today as well. Now, I'd like to thank all of you as well for participating in our event today. Thanks very much for the time that you've spent, as well as a great deal of thanks goes to Alpha Architects for making today's presentation possible. So thank everyone. This will conclude our event today, so remember you can exit using the X in the upper right-hand corner of the screen. Thanks, everybody. Have a great day, and do remember all to please trade smart. Thank you.